Let's continue with our master budget. This is the second part of the master budget analysis because we divided into the operating budget and then the financing budget. Well, the financial budget is focused very much on cash flow statement and balance sheet, um, projected or budgeted statement. Okay, so on the operating budget, we culminate the process up to budgeted income statement. Now we want to move to balance sheet and cash flow statement as the end of this financing budget. What budget? Budget and financial statement based in receipts, I mean the inflows, and disbursements or payment, I mean the outflows of a company, and that are generated by the business operation, financing, and investing activities. These budgets are oriented especially to cash. Here, guys, we don't have any loss or gains or what else. Yeah, you have not to think about if you have an expense higher than your revenue, then you have a loss, or your expense is lower than your gain and you have than your revenue, you have a gain. In this specific case, you are thinking on depositing to a bank account minus withdrawals of that bank account. I mean, your inflows, that it's money coming in the company, minus outflows, that it's money, cash going out the companies. Okay? And we divide this into three things: operating activities that are related to the core business of the company, financing that are related to the right side of the balance sheet, there are liabilities, especially long term, and equity as when you increase your shares, for example, by an initial public offer, you will increase your capital by raising cash. Okay, so you have as well, we talk about financing and investing activities are those related to the non-current assets. Remember, the non-current assets are mainly property, plant, equipment, or intangible assets of a company. There is pretty much the infrastructure of the business. Okay, and this process of the financing budget culminates with a budgeted cash flow statement and a budgeted balance sheet. What is the objective? Okay, the objective for doing this cash flow statement and balance sheet is pretty much to know the cash position planning in order to, number one, and it's the most important in this presentation, the cash could be available always when needed, especially for business operation. When you are a CFO of a company, there's no way that you can say to the production manager, sorry guy, we don't have enough cash for paying the direct material or paying the people or buying a new machinery, right? So the business operation never should stop because you don't have cash. If you have something, a shortage of cash, and you know it, if 5 months, 6 months, a year before that happened, you may act. Okay, so that's the importance of having a budget related to cash. Other idea is that if you have an excess, those excess could be invested being productive according to the risk profile of the company. You may decide to buy a new company, shares in the market, invest in new subsidiary, moving toward a new product line. So you will decide if you have an excess. Okay. What are the financing and investing activities? Well, if cash deficiency exists during any budget period, the company will need to borrow funds. Those are financing activities, and in general, as are those related to credits and loans or shares issuing, and also the costs associated with those credits. I mean, the credits are if you have a bank loan, you have to pay interest expense. Okay, if you issue more shares, you have to pay more dividends. So it's not only the financing instrument, but also the cost related to this financial instrument. If you have an excess, we'll talk about that. You may decide to invest in some assets like property, plant, and equipment, share of some other companies, new, intangible assets if you want to, etc. We have for financing budget, we may start with budgeted cash flow statement using the direct method, or also known as inflow and outflow method. This method is pretty simple, pretty intuitive. Okay, only add to the initial balance all your receipts and deduct all your outflows to reach at the end what you have on your cash flow statement. For generating a cash flow statement using the direct method, it's important that you must know that you must be an insider of the company. Okay, after that, you have to work of building a budgeted balance sheet because there's some issues in the middle. We will see on the slide later that you have to at least work in three financial statements. That is the income statement. We start with that, and the cash flow statement and the balance sheet, budgeted balance sheet statement. Okay. Or another way to solve this cash flow statement is using the indirect method. The indirect method is based on differences on balance sheet and using one period income statement, and using differences on the balance of the balance sheet account. You will calculate what happened to the cash flow from one period to the other one. This is pretty much used for analysts, yeah, in investment banking, for knowing how the companies are moving the cash flow. As I told you, inflow and outflow cash flow statement is pretty easy, pretty intuitive. Through inflows and outflow of cash, you calculate if any deficiency of excess of cash, if any, you plan your financing activities. It's computed as follows. You start with the cash balance at the beginning. You add your receipts that are your outflow or your collection. Adding the receipts to the cash balance, you get the total cash available. You diminish the disbursements or your outflows or your expenses payments, and you get there the excess, or if it's negative deficiency of cash available over disbursement. You deduct the minimal balance, because remember, you cannot have zero on a bank account, and that's the way you compute your surplus or deficit of cash. Remember, if you have a surplus, you have to find a way to invest it, and if you have a deficit, you have to find a way of getting a borrowing. Okay. Budgeted balance sheet and cash flow statement using the indirect method. First, you have to work in budgeted balance sheet. Show expected balances of every account at the end of the planning period. Is made by adjusting every amount in the historical or base balance sheet with the transaction of the budgeting period. We will see this in class. And the cash flow statement using the indirect method is based in the budget balance sheet and historical balance sheet changes, and you calculate all the effects that movements in the cash you can see if any excess or shortage is there. Let's explain this a little bit further. This is an example using sales, collections, and receivables. Those three are related to sales. There is an operating part of the company. Sales is when you start issue an invoice, yeah, and you deliver your products to your customer. Collection is when your customers pay you back, okay? And receivables is that amount of money that is sold but is not collected yet. Let's see the examples. You are in year number one. In year number one, you have sales for 100. Your credit policy is 60 days. The 60 days is 16.5% of a year. Okay, if you calculate this 16.5 times 360 days, you have 60, pretty near. Okay, 60 days you are not collecting, because the last 60 days of sales you will not collect them because you have a credit policy of 60 days. Okay, what is gonna happen? What is gonna happen is in your income statement, sales will be reflected totally, yeah, because you have the right for collecting this total amount. Your collection is going to be everything except those 16.5%, I mean the 83.5%, for a total of 83.50. That will be your inflow from collections of sales in the cash flow statement. And in the balance sheet, this 16.5% of your sales will be your accounts receivable. What is that? The 100 that you sold in the income statement minus the 83.50 that you collected in the cash flow statement, for having at the end a balance of 16.5. That difference goes to the balance sheet. Everything sold, not collected, goes into the balance sheet. What happened in the year number two? Let's continue with the story. In year number two, you will sell 200, right? You will continue with your credit policy of 60 days. I mean, you will not collect the 16.5% of your sales for a total of 60 days, right? How it's going to happen? Again, in your income statements are going the 200 of sales, and your collection, please check this out. You will collect 16.5 that are coming from the past year, right? From here, right? The accounts receivable of the past year. I mean, from year one, you will collect all the balance you have there. That, and from year number two, I'm sorry, from year number two, you will collect again the 83.5% of 200 now. So you will collect 16.5 plus 160, right, for a total of 183.50. What's going to happen in your accounts receivable? From year number one, you have at the beginning of the year 16.5, but you are collecting in here, right, 16.5. So from year number one, your accounts receivable will be zero. But from year number two, you will not collect the difference of 200 that you sold in here, right, minus the 167 you collected in here in your cash flow statement, for a total of 167. And at the end, you will have an accounts receivable of 33. So you see that one transaction impacts three different income statements, and those numbers means exactly differences. Okay, everything sold, all the products times the selling price per unit, all that you received as a deposit from your customer, and the part that you didn't receive from your customer. That's pretty much the idea, guys. For the indirect method, you have to think about these rules, okay? If you are buying an asset, I mean that you increase your asset, your cash will decrease because you're using the cash for getting that asset, okay? Imagine that you are buying inventory, private land equipment, a new piece of land. You are buying, what else? Could be a franchise. You use cash. So when you increase your asset, you decrease your cash. When you are selling your assets, I mean, when you are selling inventory, selling machinery, selling transportation equipment, you will have less assets, but you're going to have more cash because you will have there a source of cash. The opposite happens with the other side of the balance sheet. When you go to the bank and ask for a loan, you have an increase in liabilities, but as well an increase of cash, because liabilities and equities are sources of cash. When you increase your common stock, I mean the money from the shareholders, you have more cash. And the opposite happens when you pay a bank loan, you have less liabilities, but also as well you have less cash. Please have these rules in mind. Remember that the asset side of the balance sheet works exactly in the opposite way than the right side of the balance sheet, guys. And this is pretty much what we have to know about financing budget.